Good evening, everybody. My name is Sandeep Bhosle. I'm from the customer interaction team at Quantum. Welcome to our webinar today. We have our speakers today. Sorbh Gupta, fund manager for equity. We have Chirag, senior fund manager for alternative investments, and we have Pankaj for fixed income. For a better listening option, I will advise you people to have your earphones on, and you can also click on the Zoom audio button. So we'll have a presentation for around 30-35 minutes. We will take the Q&As after that. Over to you, sir.
Thank you, Sandeep. Thank you, everyone, for sparing some time out and listening to our webinar this Friday evening. I'll be covering more of an equity part. I'll start off with equities, and then I'll hand it over to Pankaj for fixed income, and then Chirag will come in for his products, his asset classes. So within equities, I know markets are kind of at closer to life highs, and there'll be a lot of questions. I'll try to address a few of them, that how things look in equities, what are the key variables to look out for if you are looking at investment or are already invested into equities. Definitely on the first slide, we talk about COVID because there is no discussions which can happen without the variable of COVID, second wave, third wave, fourth wave, and so on and so forth. So clearly we are past the second wave, and April and May, not only from an economics perspective, but from social perspective, it was terrible. Cases have come down, but as seen in some of the developed countries, there are multiple waves that come across. So we have our second wave, some of the countries are having their third wave, fourth wave, and the vaccination, the pace of vaccination is slow, despite the government trying very hard, closer to 3-4 million every day. The population base of 1.2-1.3 billion is such that we need time to get ourselves vaccinated, and that is 2 doses per person. So as per the government, they're trying to do closer to 100% vaccination of people above the age of 18. But that means that we have to give closer to 2 billion vaccinations by December. As of now, we are quite short of, we are closer to 50 crore vaccinations, single dose vaccinations. So we are very, very far away from that. So we are not vaccinated as of now. And the risk clearly is that what has happened in UK and what is currently starting to happen in US in terms of the start of the third wave or fourth wave, that can happen in India as well. And it's quite a big possibility. There are sero surveys done by the government and medical bodies which suggest that about 67% of Indians have some level of antibodies. But at a population base of 1.3 billion, 20,000 people as part of the survey universe, I believe we have to take it with a pinch of salt. So clearly there is a risk, and it's a credible risk that we might have third wave. Hopefully it should not impact the economics the way it impacted during the first wave and serious lockdown, because everyone is learning his or her lesson, how to adapt and how to work. Corporates, government, individuals, everyone. Now, how is the economic activity after the second wave? As you can see that most of the economic activity is picking up. If you look at May 2021, which is like just when the wave started to ebb, the second wave, the productions have started to improve. So cement production is closer to 80% of what it was pre-COVID. Steel production is at 97%. Crude oil production is above 100% of what it was pre-COVID. Gas production, and the most important data point, which is a representation of how economy is doing, is electricity generation, which is closer to 105%. So data seems to be coming back strongly. I'm sure June data is, we get data with the lag, so June data will look much better than what's looking at the May data. So economy is coming back. So what we believe is that since the fall in the second wave, most of the economic indicators were not as bad as the first wave and the lockdown. The pent up will be there, things will be improving, but not as sharply as we saw in June, July of 2020, because the fall was much lesser. And everybody, as I told, is learning his or her lesson, how to adapt to this environment. And I'll give you a very kind of naive example over here. It's like having kids, like so anyone who's having their first baby will be a lot more anxious for what to do, what not to do, and things like that. If they're having their second baby, they know what steps to be taken to be careful. It's very similar to that. We know first lockdown, the government knows what they did wrong in the first lockdown. Companies knew how to survive in the first lockdown. So they're much better prepared in the second wave. And if there is a third wave, I think things would be still more understandable. It will have a negative impact because lockdowns, job losses will be there, but the impact should be limited. Now, a question in everybody's mind is that if there is such a big crisis, a crisis of a century, then why is equity markets moving up so sharply, and what is driving the equity markets, and whether it is sustainable or not, and what's drove? Is it just liquidity? Is it a bubble, or there is some underlying factor which is driving the equity markets over the last 6-9 months? So this is a chart which shows the corporate profitability, and if you could see this saffron line, which shows the operating profit of companies, it's just move up sharply, and it's at the highest levels since 6-7 years, right? So companies have, and this blue bars that you see is the net sales, the sales number. So sales number is also creeping up to highest of 5-6 years, and even the margins have improved very sharply, or the operating profits have moved very sharply. The driver of that is that there is a pent-up demand for sure, and that companies are benefiting out of that. Secondly is the companies have done very well in terms of their cost control. Whether it's employee cost, whether it's other operating heads, companies have done very well, adapting to newer environment, adapting to technology. So they've done tremendous work in terms of profitability, and their margins have expanded very strongly. Hence, the profitability is much higher than the pre-COVID levels. So clearly, unlock is driving sales, profitability is better, and that is getting reflected in stock markets, right? But for sure, there is a pain in the economy, and no two thoughts about it. So the question next comes is, how is the sales coming, and how is the operating profit coming? If the economy is so much in pain, I'm sure which Pankaj will talk about it in his slides, a few slides in his macro presentation. So when we delve a little deeper, we understand that what is happening exactly is the large is getting larger and the small is getting smaller. So the small is getting crushed. That's what is happening. The concentration of economic power is moving towards companies which are larger, right? So in the listed space, listed space in India or anywhere in the world is generally a representation of larger companies. So if you look at Sensex, it is the largest companies. But overall, also in terms of listed entities, the companies which are larger tend to get listed in exchanges, and they represent the larger companies. SMEs and others who are not listed represent the smaller companies. So if you look at the left-hand side chart, the blue line represents the top 30% of corporates, right? And their sales growth, right? And this movement that I'm talking about, that large is getting larger, is not limited to COVID. It goes much earlier than COVID, with the start of demonetization, then hastily implemented GST, and then first lockdown and second lockdown. What is happening is that because larger companies have stronger balance sheets, strong management, and their wide diversified scale, economies of scale, they are able to survive these cycles better. And the weak hands are getting out in every market. And that is what is happening. So, and that larger companies are able to grow their sales much faster by gaining market shares. So top 30% of the companies, which in June 2010, about 10 years ago, were growing at 20%. And bottom 30% of the companies in India, they were growing at, say, around 10%. So the gap was closer to 10% growth within the growth. Come to December 2020, when we got this data last, the growth for larger companies, top 30% of Indian companies, have moved back to 20%, a bit higher, in fact, right? But if you look at the red line, which is the bottom 30% sales growth of companies, it is still negative. It is closer to minus 10%. So this is the impact. So sales growth is higher for larger companies, hence the profitability is higher and the earnings are higher, and that is getting reflected in stock markets. If you look at fixed assets, which is like generally most of the time, fixed asset investment is a precursor to how revenues will look 1 year, 2 year down the line, because now you put capacity, your sales will start to come in 1 year, 2 year when the capacities go on stream. So if you look at fixed asset growth, which is the capacity which the companies are creating, which was close to 10% for larger companies about 10 years ago, and 3-4% for the red line, which is the bottom 30% companies about 10 years ago. That has moved very drastically. The difference in If you look at the larger companies are closer to 0 or 2% growth in their fixed asset, but the red line, which represents the smallest 30% companies, it is minus 10%. So the fixed asset investments is also negative, right? So clearly this trend of large getting larger will continue because their investment in capacities, they have strong balance sheets to survive the cycle, and that will get reflected in earnings and P multiples and the stock market valuations. Now, what has changed post-COVID so that markets have moved up, and there are questions and people who understand how quantum equity funds work, and people do ask that why are, despite such a sharp move in equity markets, why have the cash levels not increased as much as in previous cycles? The answer is in this slide, basically. So this represents the earnings projected by some of the sell side analysts, and this is the consensus estimates of Sensex earnings over the last few years, right? So every year, the consensus puts out some numbers of Sensex 30 companies, which is collated, and for the next 2 years, how the earnings will look, that this is represented in this slide. So the background, blue background that you see is the Sensex, and these lines which are falling, you see is the consensus EPS earnings expectations of Sensex companies. So if you start from the left in say October 2014, for FY16, the green line, if you see, people expected that Sensex companies would do earnings of closer to 1800 rupees, right? But as the time passed and we reached actually 2016, the earnings came at 1400 rupees, right? So there was a downgrade. Earnings were not moving up, market kind of moved up a little, but earnings continued to fall. So there were no earning upgrades. Companies were not doing better than expected. They were doing actually worse than expected. And this trend, which was started from 2015, happened in 2016, 2017, 2018 for different reasons: economic slowdown, IL&FS crisis, demonetization, GST implementation, a lot of these factors. If you come to closer to June 2020, because of this whole COVID-related issue, there was a sharp cut in earning expectations. There was a sharp cut, and you see that slide in earning expectations of FY21, 22, 23, right? But what happened was that post the lockdown, the earnings started to surprise. As I explained that in previous 2 slides, the corporate earnings started to move up very, very sharply, and there were earning upgrades actually happening after a long time. And those earning upgrades drove kind of stock markets. And we also in our portfolio companies saw some earning upgrades, good earning upgrades. And that is the reason that stock moved up, but P multiples did not move as fast. Right? So as you know that we take cognizance of P multiple changing very, it's very sacrosanct for our process that P multiple, if changes goes beyond our comfort level, we trim the stocks. It has moved up, but it's not moved up as fast, and it's backed by some level of earning growth. So we expect that if there is a very subdued third wave, or there is no third wave, we believe that the rebound will be very good because of earnings, interest rate cycle in our favor. Real estate cycle is picking up, and some tidbits that we see is that the capex cycle should also start to pick up as the demand improves. Right. So this earning upgrade cycle should we are expecting it to continue. In case the bigger variable will be the first slide that I talked about is the COVID situation. Now this is the S&P BSE 30 index P multiples. This represents the price or the index value divided by the earnings of the Sensex companies. And you can see that it moved very sharply to 30-35 levels, still closer to 30 times of trailing 12 months earning. But one thing is important over here, that this is the P multiple based upon trailing 12 months earnings, right? And in that trailing 12 months, there is the June quarter of FY21 where earnings just collapsed because there was a very severe lockdown. Hence, this looks a little elevated optically. Once we move out of this 4 quarter, in the trailing 4 quarter, that June 2020 quarter moves out, you'll see these multiples look much more kind of sanguine and comfortable. Though it will still appear expensive, but it will appear closer to 21 times, and it won't appear as prohibitively expensive as is reflecting in this slide. Now, we cannot ignore the flows, and flows have been extremely strong, especially the FII flows. So during the COVID months of March 2020, that month they sold very aggressively. Till March 2020, they had sold closer to $8 billion YTD. Post that, when the interest rate started to move down and there was a lot of quantitative easing across the world, liquidity just flew in India also. And a lot of companies, good companies, attracted that capital, FI flow. Secondary markets, primary markets started to boom, and that is getting reflected in strong flows. Sorry, I just missed that slide. Now, if you look at CY20, there is a $23 billion of flows that has happened, right? And this is the highest since 2012. Now this flows is India is attracting these kind of flows, and primary reason is that if you look at nominal interest rates, pure the risk-free rate in India, it's closer to 6.5%, right? And in the developed world, in a lot of places, it is now negative, right? And once this whole COVID thing goes out, at nominal GDP growth rate, we'll one of the few major economies who will grow very fast. So structurally, we will continue to attract a lot of capital, and these flows should continue. Local activities which went negative last year because people were uncertain about their incomes, and people maybe thought that it's expensive now, the markets move out. But then again, it's come back. Still negative this year, but last 3 months we have seen that flow coming back on the domestic front as well in terms of mutual fund flows. So that's on the flow side. We believe that these flows should continue and should support the markets, but earning momentum should continue if there is no COVID wave. Now, all said and done, these things, one thing is important. There are near-term variables that we talk about in terms of risk. We talk about COVID, we talk about historically some policies of the government not very favorable for businesses and other things. But one thing is very important for equity investment is that you should be optimistic about where you are investing in equities. And there are enough reasons to be a little optimist on India, a little completely optimist in India. Because if you look at consumption themes in India, if you look at two-wheeler sales, passenger sales, passenger vehicle sales, and cement and housing loans, if you compare these data points with some of the other larger economies like China, or you look at the Western Europe, or you look at the North American countries, we are far, far lower, right, in terms of number of two-wheelers per household, or if you look at passenger vehicles per household, or home loans outstanding. Just to talk about home loans, India's home loan divided by total GDP is close to 10%. In China itself is closer to 40-45%, and in West developed world is closer to 90% of GDP. And we know that we all require bigger houses, that there is a nuclear family concept which is gaining pace in India. So there is long headroom to grow the mortgage books of the likes of larger NBFCs or home finance companies. So there is a lot of potential, and companies which are well managed will continue to benefit out of these longer term trends. So longer term structurally, these themes will help, and we should remain positive about long term prospects of the country. Now, in terms of longer term prospect, what does history tell us is also important, because that's the basis of how we decide on what's the future going to be, right? So definitely we have seen a lot of things happening over the last 35-40 years. We have seen prime ministers getting assassinated in India. We've seen pandemic and situation getting worse in May 2021. We've seen a lot of other things. We've seen coalition governments. We've seen wars and other things. But if you calculate an average GDP growth, real GDP growth in India, it's closer to 6%. So India still manages to grow at 6%, right? And if you add kind of 4-5% inflation in India, the nominal GDP growth rate in India is closer to 11 to 12%. And if you take a basket of good companies who can gain a bit of market share, there is all possibility that these companies can grow their earnings by closer to 13-14%. And if you own these companies, a basket of these well-managed companies in a portfolio, and without any PE multiple change, your portfolio, equity portfolio, should return closer to 14%, 14 to 15% equity returns over long periods of time. So this is what exactly is India's story. It is not about how is the third wave. It's not about what happens in Diwali or what happens in Diwali sales or what happens in the next budget. No, it's not about that. It's about that long term, India has the potential to grow at 6%. Last 40 years, we have done that. There is no reason that next 10, 15, 20 years, we cannot do that. And there will be inflation because we are still a supply constrained economy, and good companies will benefit. So longer term, if you have an expectation of 13, 14% return on equity portfolio, that's a fair expectation to have. And that should be your returns in equity portfolio for a longer period of time if you own it and hold it. I think I'll stop the presentation in terms of what we are talking about, the outlook and equities, and talk about more of our product, Quantum Long-Term Equity Value product. Now, this is a value style oriented product. In the last week's webinar, we talked about what value is and how value should outperform from here on, and why it did not perform for 2 years or 3 years in history. And we keep making these presentations. I'd love you if you guys can spare some time and attend one of these presentations where we have a detailed outlook on value and quantum long-term equity. Here, I'll just run you through synopsis. So we launched this product in 2006, and generally we own 25 to 40 stocks across sector. It's a diversified equity scheme. The objective of this scheme is to generate long-term capital returns for your financial goals like retirement, child marriage, wealth creation, and other things, because the orientation is long-term. Within portfolio also, when we buy a stock, we have at least 2 years mind frame that we are buying a stock. If you look at churn ratios of the portfolio, it is much lower than peers, because the approach is that buy after conviction, hold it for long. Don't need to churn the portfolio, because if we are saying to our investors that keep equities for long term, I have to kind of walk the talk and have my approach towards long term by not churning the portfolio too much, doing my homework and keep it in the portfolio. It's a very disciplined research and investment driven process. We have a team of people, team of portfolio managers. So there is no one man key risk in the portfolio. If somebody moves out, whether the portfolio will be managed in the same style, that continuity we are trying to ensure through the well structured way of team management. We hold shares or cash, so we don't have a derivative or hedging strategy within the product. So if the market's looking expensive, stocks are moving towards sell, we'll trim them, exit them, and we'll keep cash. And when markets fall, we deploy that cash when there is a margin of safety and we are comfortable with valuations. Now, how is the portfolio looking right now? If you look at the product in the portfolio, we have a few of the stocks which are focused towards rural economy. Over last 1.5 years, rural economy has really stood out because the monsoons for 3 years continuously have been good. In the near term, Rabi crops have been good. The farmers are making decent money. Some of the portfolio stocks are positioned to benefit from a recovery, further recovery in rural markets. So in March 2020, when the markets were falling sharply, we had cash in the portfolio, and we found out some good names within our universe to buy at great valuation. So we managed to buy them, and those companies we still hold, and they have done really, really well. So some of these companies are market leaders in their respective sectors, and they are expected to do well as the economy recovers. We are running a higher weight on NBFC, consumer discretionary, and IT. Consumer discretionary primarily because as the economy recovers, consumer discretionary tend to benefit the most. NBFCs, some specialist NBFCs, we got a very good valuation post the IL&FS crisis, and we continue to hold them. And IT is getting benefit because of whole business continuity is now relying on IT. Most of the corporates around the world are heavily investing in IT, and that is getting reflected in their earnings growth. So we hold a reasonable position in IT. One thing we are keeping in mind is that there is a risk, a very, very strong risk of the COVID third wave and disruption in the business, right? So what could we do in the portfolio? So in the portfolio, periodically, we are stress testing the portfolio in terms of balance sheet strength and business strength of companies that we own, whether these companies can survive these extreme situations. So what we are doing is whether we are seeing that if 2 months companies don't make even a single rupee? Do they have balance sheet strength or strong parentage to take care of that stress? And we found that all of our companies do kind of pass that test. So overall, the approach is that we position our portfolio towards economic growth, but ensure that all the companies, all the stocks in the portfolio have the ability to survive a steep down cycle because of COVID third wave or any other issue that might erupt over the next 3, 6, 9 months. So that's the approach that we are keeping in the portfolio. We have closer to 9.5% cash in the portfolio, and that will be used to in terms of if we get a good correction, we'll be using that to deploy and buy into some good names in the portfolio. Summarizing, where could things go from here on? One scenario is definitely boom, and it's that if real economic activity continues to improve and corporate upgrade cycle that I talked about continues to move up, it will be great. Real estate revival is happening. Stamp duty cut in Mumbai and some other places have revived the real estate market. Real estate has a lot of multiplier effect in the macro economy, and with lower interest rates, we believe that this is a very positive thing that is happening in the economy. Some of the factories have started to relocate from China because of this whole Wuhan thing and kind of China and US trade wars. Some companies globally globally are trying to move their base towards India or some other countries like Vietnam. So India should benefit off of that. Foreign flows, if continued, should be a very big positive, and we believe it can continue. Bust definitely is poor government policies, and the upcycle, that macroeconomic upcycle that I'm talking about, was nipped in the bud because of demonetization. We saw this very same signals in October 2016, and because demo happened, it got postponed. Then other things happened. So that is one of the risks that we believe can impact the whole economic recovery story. Resurgence in COVID case I've talked about multiple times, so I'll not go further. And rising inflation could dampen economic demand recovery, because if RBI decides to increase the interest rates, that will be a kind of negative for the demand recovery, because cost of ownership will move up for lot many things. So that's the summary kind of, and maybe I'll hand over to Pankaj from here on for the fixed income outlook. Thank you, Pankaj. Thank you, guys. Over to you, Pankaj.
Thank you, Sob. And thank you all of you for joining in this late evening. So I'll start with the fixed income outlook. Now we are at a very crucial juncture in the fixed income market. So we are at a crucial juncture in the interest rate cycle. So you can see in this chart, this is long-term and short-term interest rates. This 10-year G-Sec yield and the 1-year G-Sec yield. And it usually moves in cycles. So it moves up and goes down depending on the macroeconomic setup. So in the current cycle, if you see, it has been falling for very long, since 2014, when we, after we dealt with the 2013 crisis, the taper tantrum, and economy took a lot of reforms in their monetary setup. So since we had this inflation targeting central bank, and even inflation came down sharply. So a lot of it is structural. But if we go near term, interest rates are coming down since 2018, late 2018, after Ireland first crisis. And this trend got intensified after the COVID shocks last year. Now, if you see, now we are very close to historical lows in the interest rate cycle. And it seems that we are at inflection point. It is kind of consolidating at the lower level and poised to move higher in the near future. So there are certain factors which are putting upward pressure on yields. So one of it is the supply. So government is borrowing a lot of money from the bond market, and that is creating a demand supply gap. Why? Because this jump has happened very suddenly after the COVID shock. So if you see this chart in FY19, government's gross borrowing was close to 6 lakh crores. And that has actually moved over 12 lakh crore in just 2 years, whereas demand doesn't improve that much in that period. So RBI has to do that heavy lifting. They bought a lot of bond to keep yields low, but going forward, that this additional supply uh, could put pressure on the bond yields and the interest rates. So this RBI buying. So you can see from FY19 onwards, when Mr. Saktikanta Das took charge of RBI, RBI has been buying a lot of government bonds every year. In FY21, that if you see the gross buying was more than 4 trillion. So that's a huge sum, and that was the reason why we see yields at this level. Uh, in FY22, in the last 4 months, they have bought a substantial quantity of government bonds, and probably they will continue to buy in the next 2-3 quarters. But this may not be the main driver for bond yields in the coming times. Uh, Reason being that macro backdrop is changing now. Last year, we had very high uncertainty on growth. We were dealing with a once in a lifetime crisis. Uh, and nobody knew how much will be the impact. And that's the reason why RBI kind of overdone the monetary step. And they cut rate, they bought a lot of government bonds, they infused a lot of liquidity in the system, and try to keep yields low at whatever cost they can do. Now, going forward, there's one important variable which is changing, and that is inflation. So now we do not have that kind of uncertainty on growth. And on top of that, inflation is picking up. So you can read it in the newspaper every day that some or other company is raising prices. And that is visible in the inflation numbers as well. You can see that CPI inflation is in north of 6% for the last 2-3 months. And it has been higher for some time. Even last year, we had retail inflation above 6%, but RBI chose to ignore that given the uncertainty on growth. But as things stabilize on the growth front, this can become a real problem for the bond market because RBI can take some of these easing measures back. I'm not saying they are going to tighten the monetary conditions, but they have kind of given everything. So some of this accommodation they can take back, and that will put pressure on the bond yields. So this is chart of inflation. You can see that inflation has been above 6%, and the 6% is actually the upper threshold of RBI's target band. So RBI targets to keep inflation at 4%, and they have flexibility of plus minus 2%. So if it goes above 6% and sustain there, they are accountable for that. They have to act on that. So this is one big factor which can drive bond yields higher. And it's not just in India. It's globally, if you see, inflation is picking up. In US, inflation is closer to 5%. For the last decade, they were dying to get to 2% inflation, but now they are dealing with a 5% CPI inflation. So, and across the board, we have a same kind of situation. Many of the emerging markets have actually raised their policy rates in the last 2-3 quarters because of these inflationary pressures. So it seems that India is also getting into that zone. So this is a big risk. Now, if we are seeing interest rates moving up and there's a lot of supply of bond and etc., clearly this is not a favorable situation for fixed income investment, right? Especially if you are looking for long-term bonds and some generating some capital gains in the fixed income. So what should we do? There's a question I'm getting from many investors, and many of them are actually saying that should we just get out of fixed income completely and wait for rate cycle to move up and then maybe enter again? Now, please understand that fixed income plays multiple roles in your portfolio. So return is not the only objective of investing in fixed income, right? We invest in fixed income for liquidity. We invest in fixed income for regular income flows. and most importantly for diversification. So if you are investing, you are building a long-term portfolio, and you don't want to put all your eggs in one basket, right? So equity is a best asset class to create long-term wealth, but you don't want to put 100% in equities. You want some hedge, and fixed income can provide that hedge. So diversification is an important motive for investing in fixed income. Now, even apart from that, means you have objective to be in fixed income, there are still opportunity even in the rising market. So this is the yield curve. When I say yield curve, that shows bond yield at various maturity levels. So from left to right, if you move, you are kind of increasing bonds maturity. So 3-month yield is closer to 3.5% currently. And if you go very long at 30-year, that yield is slightly above 7%. So this is the yield curve. And you can see that this yield curve is quite elevated. If you see the orange line, that is the yield curve for December 2019, before the COVID shock and before RBI took a lot of other easing measures. So even that time, you see that long-term rates are at the same level where we are today. So it seems that some part of the yield curve is already pricing this rate increases and policy normalization, what we can call. Definitely at the shorter end, there is frequent rollover, and it cannot price in very far events. So there is scope for short-term yields to move up in near future. And in most circumstances, this is actually good for short-term investors, because we get higher rollover yield. So when we deploy at higher yield. So for liquid fund or funds like in those categories, these can actually gain when interest rates increase. Their returns can actually improve. But at the longer end, there is opportunity. If you see the 5-year point or the 4-year point even, yield is very close to 5.5%. So there is opportunity that you can enhance your yield by 200 basis points by going from very short liquid fund to maybe a slightly shorter duration fund. There is some opportunity, but it comes with a cost, it comes with a risk, and that risk is duration. It has a higher duration. So when interest rates move up, their prices fall by a higher proportion compared to the shorter term bonds. So there is some risk, but if you can hold for slightly longer periods, you can actually mitigate this risk. And that's an important point here. So why I'm saying this, that if you hold for slightly longer period, you can mitigate this risk. This is a chart which shows this characteristic. Now, this is chart of CRISIL Composite Bond Fund Index, and the orange line reflects 1-year rolling return. So at any given point, what is your 1-year trailing return? And the black line is 3-year annualized rolling return. So you can easily see that 3-year return has been a lot more stable compared to the when we compare it to the 1-year return. And that shows if you are holding for longer, you tend to normalize your return. And in this period, in this last 10 years, we have seen 2 interest rate cycles, 2 ups and downs in interest rate cycle. But if you look at the 3-year return, it has been above 6% for this entire duration. So that is a clear message. If you are actually looking for slightly higher duration and slightly higher return in the fixed income, you have to have longer holding period. Another point I just want to highlight here is about the credit risk, because there's another query what I'm getting from investors very often, whether we should go with a credit risk fund or invest in fund which are offering higher portfolio yield. Now, there are some structural issues with the credit fund in the Indian market, because we do not have active secondary market in the lower graded credit market. So that creates a lot of problem. Apart from that, for retail investors, please understand that in duration, if you're buying long-term government bonds and yields move up, there will be some price decline. But if you hold for longer period, you can recoup those losses, and even interest rates tend to move in cycles. So there is a chance that your returns will normalize and not lose anything. But in case of credit, if credit event happens, if you see a default, there will be permanent damage to your portfolio. Again, there is a contagion risk. We all have seen that after ILNFS. So when ILNFS, if you remember situation before the ILNFS, everybody was bullish on housing finance and NBFCs. And suddenly when ILNFS happened, the view about NBFCs changed suddenly. Nobody was able to raise money after the ILNFS crisis. And that shows the contagion risk. It is contagion. If you see default in a very small company, even that can create a panic across the sector. It is illiquid, as I mentioned, that there is no active secondary market. It hardly trades in the secondary market, so it's very difficult to get out or churn the portfolio whenever your view changes or meet the redemption pressure. So illiquidity is a big risk. So if we combine that, risk reward dynamics is not favorable in that space. Means to get that 1 or 2% extra, everything has to go right. And if suddenly if anything goes wrong, you can actually lose your capital. So not just the return part, you can even lose the capital. So that's a big risk for any investor, especially retail investors. And the most important part, it doesn't offer any diversification benefit. So it means most of the weaker companies, they do well when economy is doing great. But when we see downturn in economy, they tend to suffer. And at the same time, you find your equity exposure suffering. So you don't want both your debt and equity exposure to move in a same direction. Right. So entire motive of diversification is to have negative correlation. So again, that is getting compromised with the credit. And that's the reason why we try to avoid credit and always want retail investors from having too much exposure to credit risk categories. So what we present here is a kind of barbell strategy in the debt space. Now, liquidity is a very important motive for investing in fixed income space. So what I suggest is to divide your fixed income pool in two parts. One part, you look for liquidity, you look for safety. We offer it with the quantum liquid fund. This is our safety first approach, where we look for safety and liquidity first and then try to generate some sensible return. So idea is that you can park your money which is meant for having liquidity or your emergency corpus or any kind of money if you are conservative investor. So this is one part of the entire fixed income pool. The other part, maybe you can try to have some yield enhancement on the yield curve, going higher on the yield curve, but not taking any credit risk. So there we have active duration management offered by Quantum Dynamic Bond Fund, which actually tries to churn the portfolio depending on the interest rate setup. So when we expect interest rates to move up, we try to lower the portfolio duration. We invest in very short-term papers, which can where we can have lower impact on prices when yields rise. And whenever we see some pricing mispricing in the market or some opportunity where yields can dip, see, bond yields are likely to move up, but it doesn't move in straight line. There will be some zigzag movement. So in between, whenever you get some mispricing or things change, it tends to capitalize by raising the portfolio duration and investing in long-term bonds. So this is one strategy you can look at. Only caveat is you have to have very long holding period when you are investing in bond fund, especially at this time when overall direction is on upside. So have a longer holding period if you choose to invest in dynamic bond fund. Now, this quantum liquid fund, some of the features. So as I said that we adopt safety first in our liquid fund. So we do not take any private credit exposure. Fund invest only in government securities and few selected PSUs, AAA rated PSUs, which are actually backed by government only. So effectively, entire portfolio is covered in terms of credit risk. And in debt space, credit is equal to liquidity. So if you are investing in good quality papers, those tend to have high liquidity. Thus, in quantum liquid fund, we have very high liquidity. And we maintain a reasonable cash and very well-structured portfolio in liquid fund, keeping in mind the risk in the system. And this dynamic bond fund, as I explained earlier, that we try to manage it by managing duration of the fund. So when we expect rates to rise, we reduce the duration. We try to protect value. And when we see interest rates to go down and prices to rise, that time we try to focus on capital appreciation and invest in long-term bonds, which tend to gain more when interest rates fall. On the conclusion, now, first thing, understand when you investing in fixed income, look for safety first. Do not try to maximize return in fixed income space. You have a lot of other instruments for that. Now, you need to have a longer holding period to ride through that interest rate volatility. And especially in current setup where we expect rates to rise, you need to have longer holding period. And whenever you try to chase return, that can create problem. This is one problem when you see very high return in past. And so currently, if you see last 3-4 returns, 3-4 year returns on bond funds, so it shows very high return and people are anchored to those return expectations. So my suggestion is to reduce your return expectation from fixed income. Don't try to hunt for 8, 9, 10% in fixed income. That's not going to happen in the next 2, 3, 4 years. So be prepared for lower return in the fixed income space. And so we have already seen the bottom. Be aware of the risk in fixed income space. That's all from my side. So I'll hand over to Chirag Mehta for alternative investments. Thank you all.
Thank you, Pankaj, and good evening, everyone. Thank you for joining us today. With the outlook that Sorbh spoke about, wherein equities are biasing on a lot of hopes in the future that the momentum and growth that we have seen will kind of continue in the future. And fixed income, if you look at, is poised for higher interest rates because of the inflationary pressures that we are seeing. So out of these two asset classes, look at the third asset class, which is gold. If you look at how gold is poised, right? A rudimentary method of valuing gold is based on money supply, because gold at the end of the day is a monetary asset, and therefore its prices need to keep pace over a long period of time with how much money is being created. So if you look at gold today, apart from those two asset classes which look richly valued today, gold looks undervalued. So if you're looking at an asset class which is kind of undervalued today in the realm of things that we are seeing, relatively speaking, gold looks undervalued, right? So if you look at the orange line, which is the gold price, and the red line is the money supply in the US, the gold price is lower than the money supply line, which tells you that as per the money created, which is trillions and trillions of dollars today because of the COVID crisis being pumped in by the governments and central banks, gold today looks undervalued. Right. With that backdrop, let us see how things are shaping up in the macro world globally, which drives gold prices. So if you look at, there is a lot of optimism with the vaccination pace picking up in the developed world. Like if you look at the stats, vaccination in the developed world is closer to more than 40%, whereas in the developing world, it's still lower. And whenever, globally speaking, whenever there are places where vaccination is low, it still brings a threat to the global recovery that we are seeing. And it could still lead to the virus spreading across the globe again. So that's a good today, but it could also be a threat because the other side of the spectrum is not having been or been vaccinated as much today, right? And that is what is this optimism on vaccination that will drive the momentum that we are seeing. So far, what we have seen on growth is a V-shaped recovery. Given the pent-up demand, given the subsiding of factors, we are seeing that momentum, which is looking like a V-shaped recovery, right? And the expectation is that V-shaped recovery will continue in the future, and that is what is fueling risk assets globally. If you look at the global equity markets like S&P 500 is at record highs, and it continues to move there, right? So there is a lot of risk appetite, and that is where gold has taken a toll. Too much optimism is bad for gold, clearly, right? So if you look at what the Fed is doing in light of the growth momentum that we are seeing, Fed is saying that, we will kind of look at increasing rates, but that's in 2023, 2 years out from here. And that itself what jitters in equity markets, right? If you look at this chart on the left-hand side, right? If you look at the blue line, which is interest rates, that is a Fed funds rate, policy rate in the US, which kind of kept steady for 6 years in a row after the global financial crisis. And it was not as severe a crisis as what we saw today. Despite that, 6 years in a row, the rates stood at the zero bound. Even this year, the knock in GDP, the green line, if you see, had taken a much bigger knock than what we saw in global 2008 crisis. And recovery also has been sharp. But I think that rates are likely to remain lower for longer. Why did Fed come up with saying that, we kind of bring it forward in terms of raising rates? Because of the inflation that we are seeing. Inflation in the US has, if you look at the right-hand side chart, it has gone up significantly. It has seen a sharp uptick from what it was around 1.5%, 2% levels. It has gone to 5% levels. So that really tells you there is real inflationary pressure out there because of pent-up demand, supply side disruptions, as well as so much money being pumped in. Money was handed out to people, and that money was naturally being spent out, and therefore the inflationary pressures are what we are seeing today. So Fed had to showcase that they are not sitting right out there and watching things unfold. They are looking at things a little seriously, and given that inflation is so high, they had to showcase they are doing something about it. And therefore they said, we'll prepone rates by 1 year. Preponing rates by 1 year still means that it's going to be 2 years out. People are talking about, they will unwind or start, stop their asset purchases or reduce that meaningfully. But I think even that's at least going next year, beginning of next year, not before that. And that also will depend on how the recovery or if the momentum continues or not. Another thing that could be a tailwind for gold, those are the headwinds for gold, but what could be really a tailwind for gold is if the virus continues to mutate and if there is poor vaccine policy like what we are seeing in likes of India, right? We were kind of promised big things, but were not able to deliver in terms of meaningfully vaccinating the population. So we are seeing these waves and start-stop kind of happening in India and other places as well. So if there are virus mutations, if the virus continues to spread and leads to that start-stop kind of working in the economy, that could really want more support from the governments and central banks, and that would be positive for gold. So a combination of virus mutations and how the vaccination paces out, that will determine how things shape up on the optimism that we're seeing, and therefore how it will impact gold. One thing that, many conversations we have with investors lead us to tell that, in 2008 crisis, also they printed a lot of money and still there was no inflation. The difference between what we saw in 2008 crisis, in the aftermath of 2008 crisis response, and what we are seeing today, last time it was just QE, money printing by the central banks, and it stayed in the financial markets, it stayed in the banking circle and didn't go out in the real economy. Right? And therefore, we didn't see much inflation panning out. But this time, it's a combination. It is QE plus fiscal injections by the government. So government is spending a lot of money. That is being made possible by central bank printing a lot of money and handing it over to the government. And that is going out into the economy in form of handouts. And that spending is leading to the uptick in economy, right? If you wonder if that handout stops, if that fiscal injection stops, what will happen? Will the demand sustain or will not sustain? That's one question. And another question is, given that there has been so much money gone out in the system, whether inflation will be sticky or structurally there with us for some more time, as opposed to what we saw in 2008, but it was more transitory, right? Transitory means for a few months. Clearly, the way we are seeing uptick in commodity prices, we are seeing pressures on the wage inflation build up, government trying to increase minimum wages, all that tells us that inflation could be much sticky this time around as opposed to what we saw in 2008. And that is going to be a driving factor where gold will be. If inflation is transitory, really like what the Fed wants us to believe, then clearly gold could take a beating. But if inflation stays with us and remains sticky at a higher level, then clearly we are in for a much, you should have gold in your portfolio if that is the belief. Right inside chart, if you look at that, it's a money supply growth. It went up to as high as more than 25% year-on-year growth in money supply. That's the amount of money that they've printed. Never ever in history we have seen such high uptick. And even today, it stays above what we have seen historically, be it in the 1970s, 1975s. It still is at about 15% year-on-year growth that they are printing money at. So this really bodes well for gold, because the amount of money that they have printed and trying to push in the system, naturally an impact of that will be some uptick in growth, but whether the growth will sustain or abate is to be seen by all of us. So if you look at the gold fundamentals, there are two clearly things that drive gold, right? One is what we saw, the money supply, the printing of money by central banks. If the economy or growth falters, they will definitely, because the policy is biased towards supporting growth globally. So if growth falters, central banks are bound to print more money and push it in the economy through the use of government. Currently also, despite the recovery that we have seen, US is talking about infrastructure spending of $2-3 trillion to support the economy. So they will have to do much more if that growth momentum falters, which likely will be, because our sense is that growth from here on the global basis, whatever we have seen, the uptick is pent up demand and stuff. But from now on, it's going to be more gradual and it could slide lower. So if that really happens, then central banks will have to print a lot of money, and that will really bode well for gold. Second is they will want to keep interest rates low as longer as we see a real sustainable recovery, like we saw after the 2008 crisis, where they kind of kept rates low for 6 years. And if that happens, given the inflation uptick, given rates lower, the real interest rates, which is interest rates minus inflation, will kind of stay lower. So what we are seeing today, real interest rates in the US at -4%. Even in the high yield bond there, which is supposed to be a risky instrument, that also on a real basis has dipped into the negative territory. So that leads to a shift from a person saying, why should I keep money in a fixed instrument, which on a real basis is going to lose me money, whereas I should move into asset like gold, which will at least preserve my purchasing power. And that is where we will see some shift. Today, it is kind of not so clear, because people are kind of moving towards risk assets like equities, because they are kind of high generating, but that really creates a risk to those assets. And when that risk implodes, people will realize the stability of gold and move into assets like gold. Another thing that kind of supports gold fundamentally is going to be a weaker dollar. US has been at the forefront of all these stimulus measures, the deficits, increase in debts that we have seen across the globe. And if you look at the debt, has increased significantly to about 125% of the GDP, which is highest ever that we have seen. So that really puts pressure on the dollar. Again, the deficits that we have seen are significantly large. Even if you were to look at government's projections themselves, for next 10 years together, they will continue to run at least $1 trillion deficits each year. And that's not including any significant additional spending that they would like to do if they have to support economic recovery. So even if the base case spending that they have to do, that will also lead to $1 trillion deficits each year for next 10 years. So that really tells that rising deficits and debts in the US will put pressure on the dollar. And whenever we have seen a weaker dollar, it bodes well for gold, and we see gold prices do really well in those times. So overall, fundamentally, we are kind of looking at a favorable scenario. What really blocks that scenario is the optimism on growth and people moving into a search for yields towards risk assets, because risk assets have been one of the most return generating asset over the short term. And that really appeals to a lot of people. And without looking at the risk, they will kind of keep moving in that direction. So there are many risks on the global stage, which could, if any of those risks materialize, that could support gold. So you need to have that allocation to gold. You don't know when that risk will materialize. Timing that is very, very difficult. No one foresee COVID coming, right? And that really did better for gold. So any risk that will materialize will support gold. Fundamentally, as we saw, real interest rates, money supply growth, or be it dollar, all seem positive for gold. But until those risks materialize, or that chasing risk asset comes down, gold could remain range bound. So it could test your patience in the short term, but whenever there is the event happening, it will shine. So overall, we would suggest that you kind of maintain a 10 to 15% allocation to gold. If you've not allocated, use a systematic investment plan, allocate it equally over next 12 to 24 months and build your allocation. And you need to maintain an allocation to gold at all times, given the risk that we see. So overall, that was an outlook on gold. Now we saw all three asset classes: equity, debt, and gold. What is the kind of asset allocation that you could have to build your portfolio at this juncture? So overall, it really depends. The one variable that's not predictable is COVID, right? We know vaccinations are coming. Things will kind of get better, but in the short term, given the overvaluation that prevails in the equity world, on the premise of huge growth or continuing the growth momentum that we've seen, that could go either way. And therefore, if COVID recedes, then equities could be a better asset class. But again, you need to look at what valuation you're getting in. So at this point, you could stagger your investments again in equities as well. And if COVID lingers, then debt and gold will be better asset classes, because there will be threat to the growth momentum that everyone is taking for granted, and that will not bode well for equities. So overall, it really kind of bodes on this macro uncertainty of COVID, and that is how you could position your portfolio. But one thing is given, that you cannot be just in one asset class despite what kind of returns it gives you, because the risk that you end up taking is significantly higher. Like for equity markets, when you're investing in that at any given point in time, like what we've seen in 2008 crisis, what we have seen in COVID crisis, it could any time in a short span of time collapse by 30, 40, 50%. And you need to be ready for that. And to avoid that significant down move in your portfolio, you could rebalance or balance your portfolio with assets like debt and gold, which will give you that stability in your portfolio. So overall, you need to have all three asset classes. Like equity is for return generation over the long run, debt is more for stability, and gold acts as a good portfolio diversifier. When other things don't go well, gold is one thing that stands tall and protects your portfolio at those times. So overall, if you had a equity portfolio, for example, the annualized standard deviation of equity is around 22%, and biggest fall that it has taken since 2004 till now has been 56%. When he said fall is from the top to the bottom, it's 56%. Whereas if you maintain a portfolio of equity, debt, and gold, your returns go down a bit from 12.8% to 11.1%. But your risk, the standard deviation, falls from 22% to 9.4%. And your biggest fall that you would see in equities, which was 56%, would come down to 21% when you have an all three asset class portfolio. So that really gives you the answer that you need to have allocation in all three asset classes. And at this point in time, how that should be, given the equity valuations that we see in Indian markets, your equity allocation should be a bit lower, and you could kind of stagger your buying and build your allocation further out there, or you could wait for an opportunity. If there is any correction, you could further build that out. But if you look at our multi-asset fund, which is looking at risk more and returns later, and tries to optimize opportunities whenever they come. We are at close to the lower bound of our equity allocation range. We are at around 27% equity allocation. If I had to give you an example, even before COVID, in Feb 2020, we were at 26, 27% allocation to equities. As markets collapsed, we kind of increased our allocation significantly to 50%. And as equity markets have run up further, we have kind of lowered our allocation there. So this is what, so whatever be your equity allocation range be, depending on what kind of risk that you want to take, it could be at the lower end of the spectrum. That is what we'll suggest, given the valuations that we see. And whenever there is an opportunity like we saw in March, April 2020, that is when you could kind of increase your allocations. So look for that opportunity, be kind of conservative at this point in time, and look at optimizing opportunities whenever they come to. If all that sounds complex, one thing that you could do is what is a tried and tested allocation strategy, which we call as 12-80-20, wherein you have 12 months of safe money, which we call as an emergency corpus, lying very, very safe, be it your fixed deposits or be it liquid fund, which is kind of very, very safe, like the quantum liquid fund. And rest of the money can be split 80-20, 80 into equities and 20 into gold. And from that 80 also, we will suggest that you diversify across styles. Like, for example, what example we have given is 70% in quantum equity fund of funds, which is kind of diversified basket of 9 equity funds now. Long-term equity fund, which is a value kind of style. Any style risk that you take, you need to minimize that. So any particular fund that manages through a particular style, that you can minimize to say 15 to 20% at the max exposure, and a diversified bouquet would be a very large exposure. So equity fund of fund 70, long-term equity value fund 15, and quantum ESG fund 15, because those two on the top are certain styles that they kind of run. So this strategy has worked wonderfully well. Be it 2008 crisis, be it COVID crisis, and you know, those times you can rebalance your portfolios, and that will work wonderfully well for you. So 12-80-20, if you think anything else is complex, this is very, very simple for you to follow, and this is how you can build your portfolio. So with that, thank you so much, and I will hand it over to Sandeep. Thank you.
Thank you, Chirag. Thank you, Saurabh. Thank you, Pankaj, for the insightful presentation. I would request all our participant investors to, if you have any questions, already there are some questions in the chat box. You can write in the chat box. We'll try to take them on. So I will start with Saurabh. Saurabh, since you were presenting the consumption story on the second slide, so one of our investors had a question there. What do you mean by that 90% of GDP in home loans in the US?
No. I think it is. So I'll just try to explain this a little better. What I was trying to talk about was that outstanding mortgage debt in US divided by the US GDP is 90%. The same number outstanding mortgage debt in India divided by India's GDP is closer to 10%. Right? Now I'll give you a little more micro example that make people understand. For example, anybody makes closer to 10 lakh rupees a year as his income, maybe salary or business income, and he wants to buy a house, and he goes to the bank. Now, if you are looking for a 40 lakh rupees loan, the first number that bank will look is that you need 40 lakh divided by your current monthly annual income is 4 times. So you are looking for a 4 times mortgage to your income, right? That's that number. Right? Similarly, if you look at a company level, it's like debt to EBITDA. So what's the kind of debt that the company wants to take divided by annual EBITDA? So number of periods that will require to service it. Right? So the mortgage is a stock number, while GDP is a flow number. It is not mortgage. US GDP in mortgage, that's not the number that we are looking at. So what happens is, as countries prosper, more and more people start to earn, they will look for houses and they will take more mortgages, and companies which are providing these mortgages will tend to benefit. So India is closer to 10% of mortgage to GDP. So if I take total mortgage outstanding in India, divided by India's GDP, it is 10%. In US, that number is 85 or 90% approximate to that level. In China, it is closer to 45%. So what I'm trying to say is there is a lot of opportunity for mortgage financing companies to grow and even real estate to grow in India, because India is a young country, more people will start to earn and they will take more mortgage. That was the point that I was trying to make. Hope that point is now clear.
Thanks, Saurabh. So Chirag, this is for you. On fund of fund, traditionally we used to have around six to seven funds with an allocation of 13% of each fund. Recently, we increased to nine funds. So what's the reason for it? And also looking at the size of the fund, what do you think?
Yeah, so the very reason that we increased the size of the fund is when we kind of analyzed the impact of one underperforming scheme, which could happen because there are certain different styles of funds in the portfolio, and any one style could go through a bad patch. Doesn't mean that the fund is bad, only that the style is unconducive to the market that we are seeing at that point in time. So overall, kind of reducing the impact of one fund on the overall portfolio returns is what we wanted to do, so that any fund's bad phase will not lead to a significant dent to the performance of the overall portfolio. So to minimize that style risk, we kind of diversified further. Markets have been volatile. Markets have been going through different cycles of its own in terms of rotation of styles. Like, for example, value was not doing well across the globe, even in India in 2018, from 2017 to 2020 until COVID hit. And in the post-COVID world, value started doing really well. So, so to avoid that kind of nuances that markets bring along with it, we wanted to minimize that risk, and therefore we expanded the portfolio in such a way that we still have meaningful positions in each of the fund. At the same time, we kind of balance it well to lessen the impact of any particular style in the overall return of the portfolio. So that is why we kind of expanded. We did some back testing, we did some analysis, and we said it does really make sense now to kind of expand the portfolio from 7 to 9 funds, and that is what we did.
Yeah. Thanks, Chirag. Saurabh, what will be the present cash levels in the quantum long-term equity funds?
So it's closer to 9%. 9%.
Yeah. And another question on that, some investors do perceive that the expense ratio of quantum long-term equity fund is a bit on the higher side. And also, would you also brief on the exit loads also, why they are having?
Yeah, so 2 things on the expense ratio. When we started with, we were the only direct to investor kind of fund, and if you compare people on the regular side, we're much higher than that. But essentially, we have a clear roadmap in terms of, depending on the AUM size, we will be planning to reduce our expense ratio, and that is available on our website. So each threshold once we achieve in terms of AUM, our expense ratio will continue to move down. And this was much before then SEBI made that mandatory. Now SEBI has a defined roadmap of how to you have to reduce your expense ratios as your AUM rises. Now, but we have a roadmap. Maybe it was given out by Quantum closer to 10 years ago. That roadmap, and as we follow that roadmap, our expense ratio will trend down. That's on the expense ratio. On the exit loads, yeah, initial exit loads are a bit high, but there is a specific reason to that, and there is also a way how we use that exit loads. On the exit, the reason that the near-term exit loads are higher, that we want investors to stay with us for long, because that is how we are structuring our portfolio. A quick churning investor is bad, because if he redeems, we have to sell some of our holdings which we are holding for long, and that impacts the portfolio performance. So anybody who is exiting within 6 months or near term, he has to play a little higher exit load. But that exit load is not a profit for the AMC. It does not go into the P&L of the AMC. It goes into the fund where existing investors who have suffered or might suffer because somebody is exiting early, that money goes into that pool and it gets divided, it becomes a part of the AUM for the existing investors. Now, SEBI made that mandatory to use the exit load back into the AUM. But we had a policy, this policy since inception. So we always park that exit load, thus comes back to existing investors, and it is never part of quantum mutual fund or quantum AMC's PNL. That's the approach, and that's the reason for higher exit loads in the net.
Thanks. Saurabh, also, can you add on your outlook on the performance of quantum long-term equity fund in the coming years?
Yeah, sure. And I had highlighted that economic cycle or economic recovery aspect. Now, let me go back in history and talk about a little bit of underperformance between 2016, which was a great year for quantum, and then 17, 18, 19 were tough years for quantum mutual fund, quantum equity fund. QLTF basically. The reason is that we, as you know, that we manage the fund through value style, and a very important point that Chirag was making when he was talking about FOF was that sometimes the market is not conducive for a certain style. And that exactly happened between 2017 and 2019. When markets got very polarized, the liquidity flow was there, but earnings upgrade were happening for very handful companies. And market, because the liquidity was high, market awarded them very high P multiples or price to book. So some of one of the very market darling kind of NBFC, which was trading at 6x price to book, its start of 2019. When the year ended, it was trading at 12x price to book. So for any value manager to get into that stock was very, very difficult. That is the reason we underperformed. After the fall of 2020 during COVID, we managed to get some very good names in the portfolio, which were market leaders, and we always liked them, but they were very prohibitively expensive. And that helped us to portfolio in terms of very high quality names getting into the portfolio. And one more aspect that changed was that there was an earning upcycle post that fall, post first COVID lockdown, and that drove the earnings and some of the stocks that we owned, the catalyst started to play out, the growth catalyst started to play out. Now from here on, our portfolio composition, as I talked about, is geared towards an economic recovery. If the economic recovery continues and there are corporate earning upgrades happening, we'll see more catalysts play out in the portfolio stocks, and the portfolio should continue to perform really well the way it has happened in last 1.5 years. Now, everything hinges on that economic recovery, a broad economic recovery. And if that plays out, I think value style and quantum long-term equity value fund should do really well. So that's the kind of variable that we are looking at. But as I told you that we are also protecting the downside, and that is a very important aspect of the value style, that you have to have your margin of safety, you have to have capital protection in mind, so that those 2 points are also taken care of in the portfolio. And we remain quite sanguine about the portfolio doing well from here on, as we see economic recovery indicators in the macro economy, and the bottom up portfolio that we have created should benefit from those growth catalysts playing out.
Thanks, Saurabh. Pankaj, I think you can take this one. You mentioned in your presentation about poor government policies. Can you brief about it?
I think that was Saurav's presentation, which talked about poor government policies.
Yeah, so
Saurabh, you want to take that?
Yes, sure. Sandeep, I will take that. So as I told you, in 2016, when we were looking at some of the indicators, and since we are bottom up, and when we were talking to companies in 2016, late 2016, enough companies were talking about an economic recovery happening that point in time, because 2013 to 2016, India was kind of slowing down. But suddenly when demo happened, there was kind of real dislocation on the economy side, and that impacted a lot of economic recovery that we were expecting. Once we were almost out of that demo shock, then came the GST, right? And GST again helped the larger companies. There were again dislocation in the economy. People were not knowing how to manage things. I'm sure GST is good for long term. It formalizes the economy, but there have been near-term impacts because it was again hastily kind of presented, if I can say so. Third came the IL&FS crisis, right? And IL&FS crisis that resulted in real difficult for companies which were on the margin to raise capital or raise debt. And that resulted in a lot of companies going bankrupt, unemployment increasing, and some of the banks also failing. That was again a shock. I'm just talking about last 5 years. And then came the a COVID situation and a very sudden and very strict, stringent lockdown. Then again, nobody knew how to handle things, and things were really bad. And among all this, uh, direct support from the government in terms of money in the hand of people have not come, right? So you have not, like other countries have supported, the government has not supported its people by giving money in their hand or done anything to revive the demand. Somehow the government's approach has always been to push the supply side, improve the supply side, which we believe is important for the long term. But to near term, to increase demand, it's important to either cut taxes at the individual level, or maybe give money more. At least you need to people spend more in this environment so that the recovery is faster. But government being government, they know it better. They're trying to do it a longer way by focusing on supply side, where India's slowdown is more explained by demand side destruction rather than supply side issues in the near term. So that was the point I was trying to drive home when I was talking about the kind of government, if I can say so, missteps which has impacted the slowdown for last 4-5 years.
Thanks, Sorbh. Chirag, there's a question for Mr. Sanjay. What are the traits you see to select a good fund? Are there any ratios to watch for it, which can ultimately help an investor in selecting good funds?
Yeah, sure. So we do two types of analysis. One is quantitative and one is qualitative. So we look at a lot of data. We kind of look at returns and risk over different time frames. We kind of dissect the returns into various time periods to look at the consistency of the fund, because that is what gives us a confidence in that fund manager. Consistency cannot be just luck. It has to be, hard work, and it has to be the method that you have or the process that you have that drives that consistency. One or two times you could do it right, but that could be sheer luck, or that could be the skill. So we have to differentiate between luck and skill, and that consistency, looking at different time frames, breaking and dissecting the performance over different measures of risk and return helps us. We do look at ratios like information ratio and Sharpe ratios, etc. That also gives us certain clues on how the fund is doing. We also look at something like how the fund is doing in the up cycle, down cycle, the up capture, down capture, those kind of ratios also. But the most important thing, and I really think that's the value add that we bring to the table, is we kind of do a qualitative analysis where we kind of meet the fund manager, ask them tough questions, and we try to analyze what they're saying, what they're doing is consistent and the same as what they're saying also is being practiced. So we kind of look at portfolio characteristics, we look at different investment decisions that they have taken. We kind of ask them questions around it to kind of identify whether truly there is skill involved and not just luck. So that is how we kind of look at various funds. So it boils down to quantitative to kind of shortlist our universe in terms of funds that we should look at. And from that, we kind of look at certain things about the fund house, about the fund manager. We kind of have what kind of experience is there in the fund house, whether it's kind of process oriented, whether it's fund manager oriented, what is the succession planning. We look at all those traits to boil down to something that tells us this is the fund that I should invest in, and put the hard-earned investors' money behind it. So that is how we kind of look at doing it. But what gives us an edge is kind of doing a holistic approach of meeting the fund manager, knowing first-hand information about the fund. And second is, looking at the pedigree of the fund house, the kind of infrastructure or the teams that they have in place to kind of take it forward. And then most critical, I think, is the succession planning. Because what we have learned is many times there is just a fund manager taking that call. There is no team involved. Even fund manager is beyond the analysts that they have to kind of cover the stocks, because At the end of the day, it is the fund manager's call that happens. So we kind of dislike that to some extent, and we look at more weightage to processes as opposed to just one person taking the call. So we look at other ratios like what is the churn, what is the expense ratios play some role into our evaluation. We also look at valuation ratios in terms of how the fund is valued overall at this point in time. That also goes into how we identify the right funds. But the most critical that I think that really gives what we do is meeting the fund manager and trying to qualitatively assess that fund.
Okay. Thanks, Chirag. So a lot of this information may not be available with retail investors. So on the investor side, what do you advise them? How do they select their funds, or what they can look into a fund?
So as I said, you need to dissect the fund performance and look at the consistency of the fund manager. That is really important. And you need to see what kind of fund does the manager, what kind of manager he is. Is it a value manager? Is it a growth manager? And what kind of market cycle are we seeing? Like, for example, value was going through a tough time in 17 to 19 period. And in those period of time, in that period, if value would have outperformed, that is the time you could question that fund manager. What are you doing that leads to your outperforming? And if you don't get that convincing answer, you can exit out of that fund. So you need to see what kind of manager is, what kind of cycle we are in, and what is leading to that outperformance or underperformance for that fund manager. That is really important for you to ask that question. And most critical is dissecting skill and luck, whether the performance that we are seeing is just a coincidence, or is it the skill that the fund manager brings to the table, and that is driving the fund outperformance. So consistency, I would say, is the most critical element. You need to break the market cycle into different phases and see each of the phases how the fund has done. So at the retail level, I think that is the key to kind of try and see if the fund manager is really outperforming or not.
Thanks, sir. Pankaj, this is you can take this for you. You mentioned that government borrowing affects quantum dynamic bond fund. Can you just explain how does it relate to this?
So, see, when government borrows, the interest rate tends to rise. The supply of bond increases, and as you know, that demand supply curve. So that price of money, that borrowing cost tends to rise. So now, if interest rates are rising, that's negative for bond and for any bond fund, and especially at the longer duration fund. So funds which invest in slightly longer duration bonds, there you see more impact from interest rates rise, and that's how it is linked to the bond fund category. So overall, it's actually negative if government is borrowing more, but it's not that simple. Market always discount future, right? So some bit of it is already discounted. That supply will remain high, and that's why you see such elevated yield curve. As I've shown that short-term rate, 3-month rate is close to 3.5, but the 30-year rate is at 7%. So usually we don't see this kind of spread or the term premium in normal market situation. So some bit of excess supply is already discounted at most part of the curve, especially at the longer end. Thus, we may not see that kind of impact from elevated government supply, but yeah, this is one risk which will would probably remain in system for some time. Okay.
Pankaj, also can you take this question?
Sorry, Sandeep, this is Ajit here. Can I just butt in? I'm just about to get on to another webinar, but I did see, firstly, I want to thank Sorbh and Chirag and Pankaj and you for a fantastic, highly educative seminar. I think there were a few comments by some investors about the long-term value fund not performing well in SIP. I'm sitting on a Bloomberg chart right now, and I can see that since inception, which is 2006, we basically outperformed the BSE 30 total return index and the BSE 200 total return index. And this, of course, is net of fees and everything else. And I think one of the important things for people to realize, I mean, I'm an investor in the fund, so I do worry when value is not doing well, or when other funds are doing better, or other styles are doing better. But I think the other important thing is to recognize risk, the risk taken or the risk not taken. Pankaj alluded to it, Saurabh alluded to it, Chirag's alluded to it. So returns is one thing. For example, Reliance in the same time period, since we launched in 2006 as value fund in India, Reliance has gone up by nearly 8.5 times. And our fund has gone up by over 6 times in that period. And we don't own Reliance. And all the indices have Reliance. In Reliance, we see a lot of risk. Maybe the others don't see it. We don't know in which generation or which decade Reliance's risk may or may not unwind, or our views, for example, on it may change. But we built the value fund to balance risk and return. So just comparing ourselves, and I think you should, it's fair, it's a fair question, but there was a wrong, incorrect comment on the chat group that the fund has underperformed the indices. It has, that is true. And we know that period of underperformance was 2018-19, and there have been other periods when it has underperformed. The 2006-7 period, the very brief period of the brick bubble, 2006-7-8, it also underperformed very dramatically in terms of what the rest of the markets or indices were doing. So there will be periods when value, as Saurabh indicated, will not do well. But to say that we haven't outperformed the market over long run is not accurate. And you have to look at risk when also you're trying to assess a return. Right? So just want to clarify that. And again, thank you very much. And sorry to jump in, but I want to just address those comments on the chat group. Thank you. And and there was another comment linked that, that maybe we don't have faith and we're talking about equity fund of funds and ESG funds. Absolutely not. We're trying to find the best solution for long-term investors, sensible, thoughtful, long-term investors. And we're probably the only fund house that is telling you, give us equity money and we will give it to other fund houses to manage. We'll figure out which are the other styles that gives you a complete bucket, as you can see in this 70-15-15 allocation. If we wanted all your money, we would tell you to flip the allocation. We tell you, give us more for equity, give us more for ESG. We're trying to find you best in class and best in breed. And if Quantum doesn't have it in-house, we're happy to identify others who have it and act as the gatekeeper to figure out, as Chirag said, people who are not moving on luck, but on process, and have managed their funds and their styles very, very well. Just want to put that philosophy of Quantum way up there and hope it resonates with y'all as thoughtful investors. Thank you very much.
Thank you, Ajit. Yeah. So, Pankaj, going on, what will advise an investor to hold a quantum dynamic bond fund for how long? And also you can brief us that whether a retail investor should look at a dynamic bond fund or not.
So, see, it makes sense to have some allocation to dynamic bond fund if you have a longer holding period. So it's not meant for people who look for very short-term investment objective. Especially if you are investing in debt, any long duration fund, including the dynamic bond fund, because it has flexibility to take very high duration. We may or may not take depending on the market situation, but it has flexibility to take very high duration risks. So ideally, if you have time horizon of more than 3 years, then only you look at this fund. Otherwise, just stay away from it because it can be volatile. You see a lot of volatility in return in dynamic bond fund. But over the period, returns tend to normalize. As I've already shown in my presentation, that interest rate cycles tend to normalize over a 3 to 4 year period. So that should be the ideal holding period for dynamic bond funds.
So Pankaj, taking it ahead, how safe are liquid fund schemes? And also you can add on, does the rising deficits in the US affect here?
So in liquid fund, see, we clearly understand the objective of investors who are coming in liquid fund. It's means people park their emergency fund in liquid fund, or parking very short-term surplus cash in the liquid fund. So this is not the money to take risk, and we understand that objective. Accordingly, we do not take any kind of risk in liquid fund. Portfolio is entirely into government securities or few selected PSUs. So PSUs, when I say that, these are government companies. So we are not taking any kind of credit risk in the fund, and scheme invests in only up to 91 days paper. So there's hardly any mark-to-market risk there. There is some volatility, but I'm not saying it's zero, but it's a very low compared to debt categories. So overall, quantum liquid fund is a low risk, minimal risk kind of product. And if you are a conservative investor, you should try to look at safety and liquidity in these kind of categories, and that's what we offer. Now, from global rates, see, US Treasury, US actually sets benchmark interest rate for entire world, and especially emerging nations which import a lot of capital from developed world. They are kind of highly sensitive to changes in US Treasury rates. So we have seen quite a move in US Treasury yields compared to what we had last year. So if you remember, last year US Treasury dipped to almost 50 basis points, 0.5%, and it jumped to around 1.7% in March, and again has come down. But still, it is higher than what we had last year, and that's reflected on the Indian bond market as well, where our bond yields are relatively higher than what we had last year. So if US Treasury yields continue to rise, that will put pressure on Indian bond yields as well. And apart from that, Indian currency also linked to global yields. So there is impact from both the channels, from currency and from the bond yields. But overall, if yields are rising, this is kind of negative for the Indian bond market.
Okay. Chirag, what is the outlook for gold in the next 1 year? There's a question from Mr. Millen.
Yeah, so as I said, that it boils down to two things. One is how the growth dynamics pan out and how inflation is kind of transitory or is kind of sticky. So our sense is that the inflation is kind of sticky. It could very well be entrenched for maybe a year or two. And on the growth side, it depends on how the growth momentum kind of pans out. It is the growth. If you look at the growth dynamics, markets are assuming it's going to be a continuation of the growth momentum or the V-shaped recovery that we have seen. That could very well disappoint. So overall, fundamentally speaking, the factors are very much conducive for gold right now. It's kind of undervalued. Factors are looking good. So overall, I think gold should do well. The only risk that I see to gold is if the growth kind of sustains and kind of moves higher and inflation kind of dips. That is one of the biggest risks. And second is, given the accommodative stance that we see from central banks and the governments, given that they are pumping in still a lot of money, risk appetite could remain very well strong. And that could limit gold's rally from here on. So overall, factors look good. Excellent time to build your allocation. But if you're kind of looking at very significant high returns over the next 1 year, that may not very well pan out because the risk appetite still continues to remain strong. If that falters, then I think you could see a follow-up buying for gold that could increase. But otherwise, I think there could be a range-bound market with an upside bias in gold for the next 1 year.
Okay. So Chirag, also can you add your views on the Indian IT sector? Are they getting benefited from the US infra spending?
I think Sorbh would be great to cover it. I think Sorbh has covered IT sector in the past. So I think I will pass it on to him to do it.
Yeah, sure, Chirag. Yes, so look, so IT sector definitely is generally takes care of all the IT systems of larger companies. So Fortune 500, the top 500 largest companies in the world, spend a lot of money on upkeep of their IT and investing into newer technologies. And all these upkeep of technologies and upgrades are taken care by Indian IT sector. Now, what has happened because of COVID is that everybody is relooking at their IT infrastructure because people are working from home. You have to have your technology edge to keep your business going. And that is clearly resulting in, if you look at order books of Indian companies and some of which we own in our portfolio, that's swelling and they're getting very good orders, and whole this digital transition towards mobility, cloud and other aspects is generally what we expected to happen in 5 years is happening in 2 years, that transformation, and Indian IT sectors are just well placed to take care of that. So we are seeing that happening. There are earning upgrades that are happening, and IT sector is benefiting of this whole global IT spends on the digital side, and we are seeing that benefit, and we expect it to continue for some time.
Yeah. So, sir, would like to take this side. There's a question from Mr. Satyaprakash. Can you give the relation between higher valuations and raising cash in equity funds?
Yes, sure. So cash as a strategy in our portfolio it's a byproduct. So if you've attended one of our part to profits where we have explained the style of managing the quantum long-term equity value fund in detail, how it works is that we have a universe of stocks from wherein we pick and choose what stocks should come into the portfolio and where we want to exit that, and that depends upon the earnings and valuation. So any point in time we are looking at 2 years ahead of earnings. We have a history of 5 years earning at least in our model, and next 5 years of earning, how it will look. Based upon next 2 years earning is our arrival of our buy value at kind of 30-40% discount to the fair value and intrinsic value of a company based upon different valuation methods. It could be P multiple, it could be a discounted cash flow or price to book, and that fair value is of the company. We take a 35-40% discount as margin of safety, because when we are investing, it's more of a future. We are trying to predict, and we could go wrong, and macroeconomic could be different than what we are expecting. Our company could have deviations in earnings. To factor that, we take a margin of safety. So that margin of safety, 40% discount, that becomes our buy. As we have bought the stocks, there are 3 things that can happen, right? One is there is an earning upgrade. This means that earnings have gone up, our multiples remain the same, and because of that, our sell price moves up, right? So we will not sell even if the stock moves up till the time earnings are upgrading. That is one. Second is the rollover. So as of now, I am looking at FY23 as my base for valuation, for valuing the company. As the time passes, I'll move to FY24, financial year 24, and so on and so forth. And if that change in year, because of every year the company is growing, that also increases my sell level. And till the time the stock reaches that growth level, it will not reach to sell level, right? So I'll not trim that stock. The fourth is that stock moves very fast and it breaches our sell, so I'll start to trim, and that will result in increase in cash. So if in a short period of time market moves very fast and our portfolio stock moves up, and some of them we trim, and because markets are at higher valuations and we are not getting enough stocks to buy into with a margin of safety, our cash levels tend to increase. So this is how it operates. And as and when we see markets correcting sharply, because every stock has a beta, we have our research ready. And as the markets correct, we deploy that cash very, very quickly, because a lot of stocks which we want to buy start to hit our buy levels, and we deploy that cash. And you've seen in multiple cycles, we have seen in March 2020, our cash levels from 11% within weeks went to 4.5-5%, because we got a opportunity to deploy. This has happened in January 2016. This has happened in 2008 market fall, and multiple other times. So this is how it operates. So cash levels are generally byproducts of our buy and sell and how we manage the portfolio.
So Pankaj, this is for you. Is this the right time to start an SIP in gilt funds right now, or wait for the interest rates to raise for some more time? There is a question from Mr. Goldberg.
So you have to be clear about your objective of investing in fixed income. So if you are investing, say, very long term, your kind of portfolio diversifier in your retirement portfolio, maybe you can invest in gilt fund at this moment, where and most of the gilt fund tend to have secular long duration. So when interest rates rise, you'll see some volatility in the NAV, and there could be some decline in portfolio value. But over the period, returns tend to normalize. So and gilt funds carry almost negligible credit risk. It lends to government, so it has very low credit risk. So definitely you can do that. But again, at this moment, when we expect interest rates to rise, and if you just go by my first chart, we are at the inflection point of long-term interest rate cycle. So probably you'll see years of interest rates rise. So next 2-3 years. At this moment, investing in very long duration fund, that could expose you to very high risk. So I think you have to see your objective while investing. If you are happy with going very long at this late, then definitely you can do that. But in my advice, I guess investors should avoid taking much of duration risk at this moment. And even if you are taking any duration risk, it would be better to take it with a dynamic bond fund, because there you have flexibility. The fund manager has flexibility to adjust the portfolio accordingly. So that will be better suited.
Thanks, Pankaj. Yeah. Chirag, is this the right time to invest lump sum in gold funds? Should investors look for lump sums right now?
Given that gold looks undervalued today and there could be some volatility going ahead, what we say that you should kind of build your 10 to 15% allocation, and that you should build in this manner. Maybe 50% of that you can invest now lump sum, and 50%, I think there will be volatility over next 12 months. You could use that to your advantage and, average your cost over next 12 months as well. So, so I will say that 50% of what you have to invest, do it now, and 50% stagger it over next 12 months.
Also, Chirag, can you brief our investors what they can expect on multi-asset for the next 1 year or 1.5 years?
So I think the objective of the multi-asset fund, if you look at the fund, is try to give you sensible outperformance over your fixed deposits. That's what we try and endeavor to do in this fund, actually. So if your FDs are at 6-7% or currently at 5-6%, we will the fund over the long term will try to give you 2-3%. That's what we attempt to do while we construct the portfolio, so that we don't take up high risk, but at the same time give you that outperformance that you're looking for. And in our experience, the combination of the funds that we do, the kind of reducing risk when other things look expensive, is what we have tried doing, and that has worked well. So overall, we will try to attempt to do that. So multi-asset, don't look at a 1-year period, at least look at a minimum 3-year period. That is what I would say. And in that 3-year period and above, we will try and construct the portfolio in such a way that you take lower risk, but at the same time, it gives you that outperformance. So that is what I would suggest. And over a 3-year period, beyond 3-year period, it also becomes better from a taxation perspective. If you're in a higher tax bracket, it does really make sense to be in a multi-asset product as than to be in FD. It has kind of showcased outperformance over fixed deposits over the long run. At the same time, it has taken minimal risk. If you look at the standard deviation of the fund, if that is some measure of risk, it has been 6% since its inception. And over a 3-year period, or any 3-year period that we have seen historically since its inception, it has never given a negative return. So that is what we say when we say that we're trying to lower the risk. So over a 3-year period, it has never given a negative return. So overall, if that gels well with your objective, next time, don't do your fixed deposit, park your money in a multi-asset fund, and hopefully you will fare well over there. So over 1 year, it will eventually depend on how equities do, and we are very quick to optimize any opportunities that come our way. Like in COVID, in that just 1 month period, when markets fell significantly and became inexpensive or valuations became appealing, we kind of increase our allocation from 25% to 50% in just that 1 month. So it will depend a lot on opportunities that come in that 1 year, and next 1 year could very well be significantly volatile for all the asset classes. So predicting over the 1 year is very difficult. But if you ask me over the 3-year period and beyond, our attempt is always to try and get you that outperformance or any fixed income instrument that you are kind of looking to move away from, given the low dismal returns that you get on your fixed deposits. So our attempt has always been to lower risk and get you that outperformance. That's our endeavor. And we will try to do that using a judicious mix of assets, try to lower risk, capitalize on the opportunities when they come through.
So Chirag, do you see crypto taking gold share, which has, or would it impact gold prices?
So over last 1.5 years, there was some attention that went to crypto as opposed to coming in gold, especially from the new generation who are kind of going into trading in a big way and trying to bet on any asset class that comes and gives them that volatility and the returns that they enjoy from trading that asset class. So overall, last 1.5 year, we saw that move. But given the correction that we saw very sharp in crypto, I think that appetite is waning in a big way. Crypto went from very low levels to 60,000, 65,000 levels, and then suddenly in a few days crashed from $65,000 to around $30,000. So crypto as an asset class is very, very volatile. I don't think it will kind of ever challenge the stability that gold brings to the table. Second, they face a very big threat from the central bank digital currencies that are kind of unveiling now. Every central bank is trying to introduce their own version of digital currencies. In that light, I think it will very, very difficult to kind of challenge the might and monopoly of the central banks, and they will not want such an asset to kind of prevail. And thirdly, at the end of the day, cryptos, according to us, don't have any intrinsic value, whereas gold does have intrinsic value. So over the long run, I think gold is the asset class that you could look for stability, for portfolio diversification, and not cryptos. Cryptos is very, very volatile. Try to refrain from getting into that. So that's our opinion on crypto. You may very well see what suits you, but I don't think crypto has any intrinsic value. Today, if you see, there are hundreds, if not thousands of cryptocurrencies out there. I don't know what is the difference between a cryptocurrency and a B cryptocurrency. It's all the same. Tomorrow I can say Chirag cryptocurrency. Tomorrow you can say Sandeep's cryptocurrency. What is the difference? What brings a differentiation to them? All are same. They don't have any intrinsic value within them. So according to me, it is sort of the tulip mania bubble that we had seen in the past, and the way it went, I think crypto could go a similar way. So be very, very cautious if you are getting into cryptos.
Thanks, Chirag. We'll just take some couple of more questions. Saurabh, what will be your advice for new investors or first-time investors who are coming in mutual fund?
So clearly, if you're talking about market levels and other things, one should not try to time the markets. I think staggered approach is the best approach in the markets, either through an SIP or an planned STP or some sort of that. For a new investors, a staggered approach is the best at this point in time in the marketplace, because there is a variable which is unpredictable, and sometimes we have to agree to a fact that something is unpredictable, and we need to factor that in our investment decision. So that is one part. Secondly, as within this whole presentation, we have talked about 3 asset classes. So we should be a kind of diversification. The diversification for any new investor is extremely important. One diversification is asset class diversification that we have been talking about. Second is when you have an allocation towards equity, you have to diversify it according to the styles and the caps. So these two things, one is diversification and a staggered approach, I think is two things that people should keep in mind while investing, while being a new investor in mutual.
Also, Saurabh, can you just add your comments on should investors look for an international fund? Is there a good reason to look towards international funds?
Yeah, I think there have been a flurry of NFOs and other things, and some of the US focused funds have done well. So people are getting attracted towards that. But I would advise a bit of caution over there. First, you need to understand that whether that fund house, whosoever is launching, they have the know-how, or it is more like sitting here in India and deploying in some famous names in US. So I'm not sure how many people have the wherewithal to understand the risks which are happening in US market sitting out in India. That is one thing people need to be extremely careful about. And secondly, what I understand is that within India, within our universe, you have enough companies which are very good companies and which are doing very, very well. And even if you want to have a US exposure, there are export-oriented companies like IT, pharma, where you can get an exposure. The annual reports are in India. You can read those annual reports. You can meet the management, which is very difficult if you are investing in some hotshot US name which is going up daily, right? So I believe most people do not understand the risks of US investment, or any, for that matter, any other economy. And unless you understand that aspect, we should not just go by returns and rush into those kind of investments. One has to be cautious about those investments. That's my view on whether one should be investing in global funds.
Just to add to what Saurabh said, right? The risk for US equities have not materialized significantly over the last few years, and that is why it feels like a good factor or a self-fulfilling prophecy that it does work for me. One thing to remember is people invest in offshore equities is for diversification of geography. And second is diversification or a hedge on the rupee, right? Rupee has been depreciating asset class or a depreciating currency for years together. And therefore, to hedge against that rupee depreciation, an offshore vehicle does help you. To some extent, an allocation to gold does fulfill those, right? It does fulfill the need for diversification. It does fulfill the need for rupee depreciation hedge as well. So overall, sometimes simple things does help you. You don't need something external or a fancy thing. Gold allocation is itself enough. And time and again, we have seen, be it the COVID crisis, the global financial crisis, or any of the crisis, equity markets across the globe have become more correlated. So if US markets fall, we see a fall in our market as well. So you don't get the diversification in a very real way. Geographical or revenue from companies differ, and therefore that is one source of earnings diversification. But otherwise, when you're looking from a portfolio perspective, it does not really give you that portfolio diversification because those equity markets are very, very correlated. So I think a simple thing like an allocation to gold will be enough if you're looking for that, and don't look for fancy stuff, because the risk has not materialized over the last few years doesn't mean that it will not materialize going forward as well.
Yeah. Thanks, Chirag. Saurabh, what is your view on investment in electric mobilities and its allocation in the portfolio?
Yeah, so it's a very evolving thing, and we have been looking at very, very closely because we have some of the auto names in our portfolio. As of now, our sense is that getting the technology is not that difficult. EV technology, most people can source that technology. Ability to scale up is a challenge, and where we still believe that we actually very strongly believe that some of the existing players of internal combustion engine manufacturers in India are doing good enough to get into that technology and creating good product portfolio, which they plan to scale up. And we have been in touch with those managements that what kind of steps they are taking on the EV side. So we believe that some of the existing large two-wheeler players have the cash in balance sheet. They're investing in right products, and they will be able to scale up. The only thing we want to see is profitability. Now, globally, some of the names, larger names like Tesla and other companies have started to show some profitability, but One thing that we'll be very closely watching out that how profitable is that business, right? And that's where we are keeping a very close watch. But not many plays are available in India, direct plays, but we strongly believe that existing two-wheeler or four-wheeler companies have their balance sheets in place, have their act in place, and they will be beneficial because they have strong distributor reach, good brand, and their ability to scale up is proven. So instead of trying to find out a fancy name and which is just like 100% EV, where the business model is not evolved, the management track record is not there, better bet on proven names on this side. That would be my view on the EV side.
Thanks. Thanks, Chirag. Thanks, Saurabh. If you can just give your last final comments or advice to the investors in short, both of you.
Sure. Sandeep, we have been talking about how equities will play out. Now, our best advice is there will be challenges in the near term. There will be volatilities. As an investor, if you stagger invest in equities, you can benefit out of that volatility. And please keep a long-term view in mind, and you'll see that you get decent returns over long periods of time to take care of your financial needs, financial goals that you have in the long term. So long-term approach in equities, and stay clear from fancy things. Now, a lot of fancy things. So people are asking about crypto. People are asking about EV. People are asking about other fancy stuff, overseas investing and other things. Keep it boring, and I think that's the key of making decent returns in long term in equities. Thank you.
Thanks.
Yeah, so there are numerous risks out there in the global markets overall. Don't know when and which risk will pan out. The central banks and governments are doing one thing, is kicking the can down the road. They are kind of delaying the day of reckoning by pushing money or giving money as a solution to any problems that they face. But there could be an end game, and I think an allocation gold will really be helpful during those testing times. So if you're not allocated to gold, please build your allocation sensibly. Gold looks undervalued today, but the risk appetite that we are seeing, the chasing of risk assets globally, is kind of shadowing gold's rise or limiting gold's rise. So overall, this could be a good time to build your allocation. It could be range bound, it could be volatile over next 1 year or so. But that is take it to your advantage and build your allocation to gold. An allocation to gold in today's uncertain times is a must. There are various risks, be it deficits, debts rising, the optimism on growth, the inflation spiral. All these could manifest into a big risk going forward. So have a portfolio diversified across asset class, and gold is an important element to that. Keep it simple, like Saurabh said. Split your assets into different buckets and allocate across. If you don't know how to do it, this 12-80-20 could be a real simple strategy, or you could use something like the quantum multi-asset fund as a way to diversify across asset classes, and that could be enough for you. So stay invested, stay healthy, and be safe. Thank you.
Thanks, Chirag. Thanks, Saurabh, for those insights. Thanks to all our investors and attendees and participants today who have attended this presentation. This presentation will be also available on Quantum's YouTube channel soon. We will inform you about that. Thank you for giving your time to us. Thanks a lot. Thank you. Stay safe. Thank you.
Thank you, Sandeep. Thank you, everyone.
Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.